Hello, welcome to our October 2023 market update. I'm Victor Connor.
I'm Max Westerman.
And you know the team. As a matter of fact, we're going to start today introducing our latest financial advisor. You see the third picture, Josh Johnson? Well, watch this.
Whoa! I'm in here. Am I in here? I think I am. Ooh, I gotta get closer. All right.
Hi, welcome, Josh. Welcome to the front of the camera.
The front of the camera. Oh, I feel special. I feel like I'm here in the front for once. I'm usually back there, but not today, Max.
Nope,
Today.
not today. Welcome to the front of the camera. All right, we'll continue. So, the underlying thesis. Number one, we've gone through this before, but our underlying thesis is, number one, 90% of the things you worry about never happen. Number two, the results. We make observations, not predictions here. And number three, Occam's razor, which is simply known as the simplest explanation, is usually the best one. And finally, number four, supply and demand, economics 101. It applies to markets as well as most products. All right, let's get into it. Major market indices. So we have the top one. How's the Dow doing? This is as of close of business on Thursday afternoon, beginning of Friday of last week. The Dow is up 2.5%, let's call it. The S&P is doing a little better. We're up 13.5% there. And then the NASDAQ, which is roaring this year, is up 29%. So as you can see, there's a little bit of a pullback in September. But still, especially in the Dow, there's a big pullback. But if we look at, especially in the Dow, the second line down on the Dow, under the first circle, the transportation average, so that's rail cars, that's logistics companies, those are up 12.5%. So that's being really strong in the Dow, and that's what's supporting it. So utilities are getting hammered. They're down 14%. NextEra. Call us if you want to talk about what happened at NextEra. We'll go through that. But, all right, the NASDAQ's still roaring. All right, let's continue on.
Max, I think you could say that NextEra is in its next era. Is that correct?
Yeah, exactly. All right, let's continue on. You'll see that we have the daily moving averages. We have the 20, the 50, and the 200 day. So the 20 is the green line going right there. We have the 50, which is the red line, and then the 200. And then what's that over to the left, Josh? We got what does it say? Golden Cross?
I think it says Golden Cross, Max.
Yep. So that means right there you can see it's the 50-day moving average crosses through the 200-day moving average.
Whew.
And when was the low, Josh? What does that say?
It says that the low was at 28,660, almost 1 year ago today.
1 year ago today. So 1 year ago today, we hit the low in the markets, and let's continue it that way, and hopefully we don't go down there anytime soon. All right, the S&P 500, that we're making sure that correlates with what's happened in the Dow. You'll see we also had the Golden Cross there, and then the bottom of the market was 1013 a year ago, like Josh just said, a year ago almost to the day. So the bottom of the market. All right, now we got the NASDAQ. Now that's been roaring for this year. Last year, we were down about, 30%, Josh, last year?
Yeah, we were about 30% down last year.
So right now we're up 29%, so we basically made up for it. So we'll see what's happening. We'll see what we finish out the year. And we'll get into it later, what happens in the summer months. It's a chart later in the presentation. But right now, September is always a bad month, and October is usually a pretty bad month. But August, September, and October are usually the low months of the economic calendar. So seasonality. Okay, so here we go. Next slide was the presentation. August, September, and October, a clear history of seasonal weakness. As you can see on the far right, the S&P 500, the average monthly return since 1954. Before you and I were born.
Before, just barely? Ooh, Max, a little bit vain there. Come on.
So, as you can tell, the 3 months, August, September, and October, those are the lowest points on the S&P calendar. And September is, since 1954, has been on the average down, what does that say? almost 1%. So, wow. And Josh, you want to make a point about this slide?
Oh, yeah. Well, we're here right now. We're right now in that area, Max. It only seems natural that we would be in this area right now, right? And in this kind of in these conditions right now, given the information we're showing on screen, right?
Exactly. And everybody remembers, I'm sure, the 1987 crash. I'm sure Victor will give you a good story there. So everybody remembers that crash. Obviously, that happened in October. So we'll see how October finishes. And then if you go one month over, look how strong November usually is, and December usually to finish the year. So hopefully we'll go into there strong to finish out the year. This month in the market: strikes, jobs, rates, China, and cyber attacks. All right. Josh is going to talk about this.
Ooh, I'm going to talk about this. All right. So first we have up the UAW strike. The UAW strike spars automakers from financial pain. I'm sorry, spares. Spare automakers from financial pain.
Tongue twister.
For now, it is a tongue twister. 3 weeks in, the United Auto Workers strike against Detroit car makers has nearly all the hallmarks of a dug-in labor battle. Euphoric worker walkouts, rush contingency plans, and wall-to-wall media coverage of fiery rhetoric. Max, what's all this about?
What's all this about? Basically, the deal is what's happening is automakers, the UAW, the labor unions want to strike a deal with the automakers to raise their pay. They saw what happened with UPS. The drivers got a lot more money, and they want the same compensation, basically. President Biden flew there a couple weeks ago because his big thing coming into office was he was going to stick with the labor union. So he came there a couple weeks ago and went and talked and proposed basically the labor unions need to meet with the car makers and strike a good deal on both sides of the aisle.
I think that they need a good deal, Max, for both of them.
I think they do too, so we'll see what happens. The UPS drivers are starting to make $6-figure, $100,000?
I think so. After a couple years of working there, they get the opportunity to make a lot of money.
A good, decent wage.
Of bucks. Yeah.
So hopefully it's the same with the UAW and the labor unions there, but we will see what happens.
Hiring accelerated with 336,000 jobs added last month. You know, Max, do you see more workers this season?
No, Josh, actually, I think it's going down.
You think it's going down?
Yeah.
I think so, too. You know, we just read an article from Macy's, isn't that right, about their hiring this year?
Yeah, Macy's is going down, and a few others, right?
Yeah, that's right. Only, I think, 37,000 jobs were added at Macy's for this season. The seasonal hires this year, folks, compared to last year, I believe it was 50,000, and the year before that, 77,000 workers were hired. So, yeah, I mean, we do have workers and jobs being added, but people are no longer hopping around.
So is Santa Claus not coming to town this year?
I don't know, Max. That's yet to be seen. But I will tell you that I'm hearing Mariah Carey already in the department stores.
Oh, wow.
And speaking of Macy's, they're already all set up for Christmas this year. We're talking ornaments. We're talking the tinsel. We're talking the faux trees. We're talking the stockings. Already
Did
there,
you already
Max.
make your wish list?
I did make my wish list for a bull market. That's my number one wish, folks.
Same here.
Same here. I know it. All right. So, yeah, 336,000 jobs added last month. That is significant, folks. What's causing this? My personal opinion, I believe it's the fact that people aren't hopping around anymore. Previously in the markets, we had people going around, jumping from job to job. Sam, working at Google, would go ahead and say, I really don't think I want to work at Google anymore. And he would move to Microsoft for better benefits, better pay, and better quality of life. And, you know, it's funny. Max, do you know what one of the number one things is for our generation, millennials and Gen Z, what they're looking for?
I do. I have a friend that I went to dinner with on Friday night, and he's trying to go to Next Era, which we just talked about. He's trying to go to Next Era or FP&L for a job, and his number one thing was he gets to work remotely.
Work remotely. So people were looking for these jobs where they could work remotely. And the second highest thing that they wanted, or one of the top ones, was mental health support in their insurance. Millennials and Gen Z, that's what they're looking for. But that's not to mention, Max, that the industry that we're in right now is the number one budding industry, according to CNBC, for Gen Z and Gen X workers.
Wow.
Yeah. Anyways.
So the big thing also here, Josh, to highlight is with the added jobs, the 336,000 added jobs, there's been a big debate. Are we going into a recession? Ooh. Now, the Fed, they've been talking that they want to have a recession. And then what? Basically over the course of from Friday to today, now they're saying, economists are saying, we're not having a recession. So we'll see what happens. We'll stay tuned.
Wait a second. Is their crystal ball broken?
I think you got to look at what Jerome Powell's briefcase.
Jerome Powell's briefcase, or the pizza's coming out of the Fed.
Oh, the pizza's coming out of the Fed. All right, Josh, what's happened with mortgage rates?
They hit 7.49%, the highest since the year 2000.
Wow.
Bubble.
.com bubble.
How old were you in 2000, Max?
2000, I was 8.
8?
Yeah.
Let's see. In 2000, I was 5. No, I was 4. I was 4 years old in 2000. Yeah. Yeah, that's how young we are, folks. That's how young we are for the .com bubble, right? The average 30-year fixed mortgage rate hit 7.49% this week. That was last week. A fresh 23-year high, mortgage giant Freddie Mac said on Thursday. The rate was 7.31% last week. That was 2 weeks ago. Adjustable rate mortgages, which typically carry lower rates in their early years, are often a popular option when rates go up. They made up 8% of mortgage applications last week, compared with a 5.6% over the past 5 years, according to the Mortgage Bankers Association. Max, is that a sign that housing markets are weakening or getting stronger?
Housing markets are definitely weakening. We just saw a article in the Journal. I just saw one this weekend. Josh saw one last week. Basically, they're talking about rents, especially in Miami, going skyrocketing down. And so we'll see what happens there.
Miami. I think that's where Pitbull lives. The singer, the rapper, Mr. Worldwide.
So rents are definitely going down. I mean, I saw rent in Miami's now at $2,400 for a 1-1. And during the pandemic, they were at around $4,000. So rents are coming down, and they make up about 40% of CPI. So if rents and housing start coming down, that means inflation will come down. So fingers crossed that rents are coming down.
And the cyber war. MGM Resorts refused to pay ransom in cyber attacks on casinos. Max, what's this about?
So basically what happened is MGM, a lot of the major casinos in Las Vegas, fell under a cyber attack. And when was this, Josh? When did this happen?
This happened last month.
So this happened last month. A giant cyber attack during a conference which has all the cyber criminals come. So I don't know if that was the smartest idea to have these to host the cyber criminals come and have a cyber criminal conference at your hotel. Anyways, so they were attacked and held for ransom.
Now, Max, if I was there and I couldn't gamble on the floors because the slot machines are down, you know what I would go do?
What would you go do?
I would go to the bar, but the bars were not working. And
the bars weren't working.
So
either?
if I couldn't get a drink, well, I would love some entertainment. I would go to the fountains. But guess what? Those giant fountains, they weren't working either.
Wow. So nothing was working in Vegas during that month.
Nothing was working. Nope.
All right.
And so, yeah.
Josh, talk about this.
Yeah, and so if you guys are interested in becoming more savvy cyber, you can go ahead and scan the QR code on screen right now. You guys can scan the QR code on screen right now to go ahead and get access to the to our Savvy Cybersecurity Seminar, where we go ahead and we talk about all the tips and tricks you need to know to keep yourself safe.
All right, so has the Fed been successful in slowing inflation? Where are we now? Let's look at some actual numbers. We go through this pretty much every time, and every time it's a little different because it's a month later. So let's see where we are. So we've had this slide in before, but it's a good refresher. So from 2000 to 2020, the average inflation rate was 2.18%. Now this is where it gets startling. 2021, it was 4.75, a double there, a little over a doubling. So that's in 1 year it doubles. Then in 2022, it peaked at 9.1% in July of 2022. That's almost another doubling. So in another year, so in 2 years, it went up 4 times, 400%.
400%, Max.
That's crazy.
That is insane. That's like, you know what that reminds me of? It's very reminiscent of what happened during the OPEC oil embargo after the Yom Kippur War.
Yeah.
400% increase in oil prices. Very eerie. Very, very eerie.
All right, so commodity prices, they have peaked, thank gosh. And all right, so we have on the left side, we have oil, but we'll see what happens, just like Josh was talking about. We'll see what happens there. But they did peak, and those were in all of August of last year. Or, I'm sorry, of October of last year. They all peaked. So we have oil on the top left. We have lumber on the top right. Then we have wheat on the bottom left, and also coffee. But Josh, do you still paying exorbitant prices in coffee?
Oh, not anymore, Matt. At Starbucks, yes. But I like to roast my own beans at home.
Wow. Wow. When are you going to bring that in for us?
Very soon, Max. I just have to get a proper grinder to do it.
Okay, all right. So I can't wait to try that coffee.
But yes, it is.
If you guys want to try also Josh's coffee,
feel free to
feel
come
free
in.
to give us a call.
No, and you know, on the Starbucks thing, Max, you know, it's very interesting. Back in university, I used to my go-to Starbucks in university was I would like to get a cold brew coffee with 2 shots of blonde espresso. It was about $6 for the whole thing. Mm-hmm. Now it's about $9.50 for that same cup of coffee. I'm not made of gold bars, Max. I can't afford Starbucks coffee. That's why I roast and grind my own beans.
Wow. So, but mission accomplished as far as what the Fed has done in terms of bringing down the commodities. So this is the commodity index. This is basically the S&P 500 of commodities. It's dropped from 135 plus in July of 2022 to now 102. That's a 26% drop. So commodities feed into a lot of our everyday lives, and also with rent coming down, I think inflation, the Fed still wants to hit that 2% target. They talked about that all the time. They're at 2%. That's where they want to be. So we'll see when they achieve that mission. So core CPI data, this is what we were just talking about. You can see it right now. It was over 6.5%, and that was in 2022, and now we're down to 3.3%. Wow. That is a huge steady drop. So is Jerome Powell doing his job? I think so. I think he's doing a pretty good job for the cards he was dealt.
You know, Vic keeps asking me what this YOY means. He keeps thinking it means yo-yo. It doesn't mean yo-yo, folks. It means year over year. It's not a yo-yo like a yo-yo.
Even though the graph looks like a yo-yo.
It does look like a yo-yo. Yes, it does, Max.
All right, so Josh, why don't you talk about this?
Right, so this is going back all the way to 1989, Max. But our first point is going to be at 1993, the last time.
Is that because that's when I was born?
That is when you were born, Max. I don't know if people did the math earlier when we were talking about 2000.
Yeah.
But Max was born in 93. So yeah, that was when rates were at the same level that they are now. And then we go over to 2000 when the dot-com bubble was. Oh, wait, you can see that significant dip there. And then you can see 2020, where we had a drop to almost 0% rates. Then a rocket up to the top at, let's call that 6.8%. And then a drop right back down to where we are today. So, Max, is the Fed doing what it's supposed to?
I think they're doing a great job. I mean, when you inject billions and billions and billions of dollars into the market as free money that's slushing around, inflation is going to spike up no matter what. And so, yes, I think the Fed has been doing a great job. I mean, we were talking that what the Fed has done since the beginning of the year, it's 20-fold of interest rates.
20-fold.
20-fold. So that's how much they've gone up. We're in historic times right now, and I think they've put bullets in the gun when they needed to be put in.
I think one of the most striking things about this, Max, is the fact that we get to live through history.
We live through history every day.
I know we do. We get to live through this history.
Exactly. It's exciting.
It's very exciting.
So current rates. This is just goes off what the slide we were just talking about a little bit. Where current rates, they've gone historically up 20-fold since the beginning of the year. So they're at, 5.5% right now. So, Josh, you want to talk about the future?
I would love to talk about the future. AI in jobs and AI in art. Humans in the AI era.
What is AI, Josh?
Well, that means artificial intelligence, Max. That's what I have. I'm a little bit artificial in my intelligence. But
Wow.
New jobs for humans in the AI era. Large language models such as OpenAI's GTP and Google's Lambda are trained on massive amounts of data scraped from the internet to recognize, generate, and predict language in sequences. For the finance industry, this makes them a bit like a new college graduate. Not much use without more specialized instructions. That's what I mean when I say I'm artificial. I have specialized instructions, Max. Specialized instructions.
Specialized dance moves?
Specialized dance moves. Choose. I can do like two. The robot, and I think I can do the worm. But I have to work on my worm.
Josh, we were listening to the Joe Rogan podcast.
Yes,
and
we were.
Who was on that podcast?
Sam Altman.
Sam Altman. What does Sam Altman do, for those of you that don't know who he is?
Sam Altman is the CEO of OpenAI and the guy who helped create ChatGTP and their image generation service, DALL-E 3 Mini. Kind of like the Pixar cartoon, but instead with a D. Yeah, he's the CEO of OpenAI.
So what did he talk about in terms of jobs?
In jobs, well, Max, he believed if you asked him a couple years ago, that how AI would have evolved in the job world is at first it would have taken over blue-collar jobs via robots, humanoid robots. Then it would eventually come for more analytical jobs like the finance industry or math teachers or
Artists?
Art would be the last one, though, Max.
Yeah.
Art would be the last one. Today, you can go ahead and be almost confirmed that model has been flipped on its head. And according to him, it has. These are DALL-E 3 AI art generations. And what I went ahead and did was I put in 3 just prompts, and it came out with these images. And these images are 100% AI generated. That's pretty crazy, isn't it, Max?
Yeah, it is crazy.
And it can do really good art. Not perfect, but really good.
So, since you put in this prompt, do you own these photos? Are you copyright?
I do not own these photos.
Okay.
I believe OpenAI owns
OpenAI,
them. Okay. Yeah, but because we own the subscription to it, we can use them in the presentation, and it's very interesting. If you actually look at the image farthest to the right, if you look at that guy who's has the gray hair in front, he looks very, very much like the actual guy who wears like the Dow 30,000 hat.
Yeah.
It's such an advanced system. It's able to compile all the images of what the New York Stock Exchange floor looks like and go ahead and show what certain people who are even famous or who are famous on the floor look like. And that's just mind-blowing to me.
So another interesting thing that what has been happening in the public sector is there was also another strike. There was the writer's strike and producer strike out in Hollywood. And that's because of AI. They were fearful that AI would replace their jobs, like Josh was just talking about. And because you can instantly, Josh created this art instantly almost.
Yeah.
And they could produce movies, could produce and write scripts. Josh and I are going to start doing a podcast, so stay tuned for that. But I went ahead and said, well, if we're doing a podcast, we're having an asset manager on as our first guest, and
a very good one,
a very great asset manager. What would be the formula to structure this podcast? And in 5 seconds, it came out with the formula of how to structure this podcast. So it's going to be interesting, so stay tuned for the
craziest
podcast.
The craziest part here, Max, to me is that I can draw a stick figure. I didn't even have to go to art school to learn how to make a illustration in a vintage style of a male stockbroker in a sharp suit looking elated and raising his fist in celebration while the stock market board behind him displays soaring numbers. I didn't have to go to art school to do that.
Is that going to be you when you get your Christmas gift?
That is going to be me when my Christmas gift of the bull market comes around. Absolutely, Max.
All right, so you might be wondering, what are we doing for AI? How are we using it in our practice? So we're using generative AI. We've talked about this before in our practice. We're using it with tax returns and estate planning primarily. So that is what we're doing with AI and how we're using it, because we believe you got to adapt, and if you don't adapt, you fall behind. So we're adapting. We're putting AI into our practice. So we're having with income tax planning and also estate planning. All right, to sum it all up, perspective matters. So perspective, bullet point number 1, to have a meaningful use, data must be put into context or perspective. So let's say your team scores 21 points. Did they win or lose? Was it a good game or bad game? Well, Josh, if you're playing basketball, is 21 points a good score?
No, it's a terrible score.
All right, so what about soccer or football?
Oh, Max. Well, for footy, yeah, no. For soccer, it would be also an amazing score.
It would be an amazing score. So it's data, it's perspective, right? So 2008 banking and real estate crisis and the 2020 COVID shuts down the world economy. Those are tragic economic failures. But in today's perspective, what we're going through, I don't think is as bad as what was happening back then when all the banks were collapsing. We had COVID when the entire economy shut down. Oil went to negative. So both periods of 2008 and 2020 were followed up by strong recoveries. So I think we're going to have a strong recovery based on what's happening. Hopefully Josh's, again, Christmas miracle comes through.
I'm going to write my letter to Santa right now.
Yeah. So how does today's inflation issue compared to COVID? Let's go through some perspective. All right. So as you can see right here, it might be a little difficult to read, but COVID. So basically COVID 2020. What happened that year was we were down, I think, 45% in the month of March. We were down 45%, and then to finish the year, we were up 15%.
That's called beautiful gains, Max.
Exactly. So, but if we were to tell you, hey, you know what, the world's economy is gonna shut down, and then your portfolio is going to be up about 15%. You would have said, are you crazy? There's no way in hell my portfolio is going to be up 15% if the entire world's economy is going to be shut down. So it pays to stay in the market. We have to stay invested in the market. And we'll go through in the next couple slides of why. So first we'll do the bond market. So what's happening to the bond prices? So if you go to the middle paragraph, compared to the record and modestly positive inflated adjusted long-term interest rate, which is what the U.S. has gone to in great threat of prosperity, more normal yields will discipline markets in ways that could boost growth over time. So what's happening in the bond market is basically over the period of, 40 years, the bond market has gone from a period of lowering rates, and now we're in a period of what we talked about. The interest rate has gone up 20-fold in a matter of 7 to 8 months. 9 months. So interest rates have gone skyrocketing up. That's why your bond portfolios, you might see when you get your statement in the mail, the prices might have gone down because of what's happening with interest rates. However, if you hold these bonds till maturity, you're going to get your principal back. So
my principal from high school?
Yeah, she's coming back, Josh.
Oh, no, God, no.
So that's important. Call us if you have a question about your bond portfolio when we'll go into further detail about it. All right, so Josh, you want to do this about perspective a little bit?
Absolutely. 10 years, 2014 through 2023, through June 2023 to be exact. 7 years up, 3 years down. Up to down ratio, 70%. Now, look at 2020 in specific, right? Even with that massive drop due to the pandemic, we still ended up 15%, what Max was talking about before, right? 15%. That's crazy. Look at the correction that we had in 2018. We were down for that year, but not by much, because the next year we were up over 25%. for 2022, right now, even with everything how it looks, with all the conflicts going on in the world, we're currently up over 10%. That's crazy, isn't it, Max?
That's crazy. And
and
so
just like
what
I
is
was
this
saying really quick, it is just sweet games. Go ahead, Max.
So it pays to stay invested in the market is what this is illustrating. It pays to stay invested in the market because through all this turmoil, through all this volatility, there's more green than there is red.
Looks good.
So Josh, what's the 20 years tell us? We're going to go back even further.
We're going to go back even further. 20 years, 2004 to 623. 16 years up, 4 years down. Up to down ratio, 80%. Still, look at that. In 2008, where we were down hard, we still ended up the next year up over 20%. And the year after that, we were up over 10%, between 10 and 15. Let's call that 14%. The year after that, 2012, guess what? We were up. 2011 we were flat, and then for 2012 we were up another 10 to 15%, 14%, and then going into 2015 we were up over 25%. Wow! So Max, all of that negativity in 2008 and the years after that, it seems like we were up hard, right?
Yeah.
Leading into 2014, and then still, look at the correction in 2018 compared to the rebalance in 2019 of being up over 25%. It's history, folks, and you can see it right there in what you're looking at.
Yeah, and it's pays to stay in. Again, it pays to stay in. And we went through, Josh, how many banks collapsed in 2008?
Oh, I don't remember off the top of my head. A lot. The answer is a lot.
Bear Stearns collapsed. We could go a list of banks that collapsed in 2008, and then the following year we're up almost 25%. And so same with COVID. Again, the entire economy shut down. The entire world shut down. And then the following year, that year we finished up, and then the following year we were up over 25%. So it pays to stay in the market.
And 30 years now. Years 1993 to June 2023. 22 years up, 8 years down, an up to down ratio of 73%. Basically what we're showing you here with the ratio, and the what I want you to take home from all of this is that we are about at, no matter what the dip is, in the past 30 years, the up to down ratio has been over 73%. It pays to stay in. Listen, guys, I'm sure some of your grandkids, or maybe even your kids, are those short-term crypto investors. Or maybe they're those meme stock kids who love the ape, right? The unit shares of Bed Bath & Beyond, or AMC.
Or GameStop.
GameStop,
Your alma mater.
My alma mater, yeah. I was at work at GameStop at one point. Yes, so maybe they're like one of those. Those people got wiped out because they are short-term investors. When you look at the long term, it pays to stay in, clearly by the data.
I just want to go through something real quick. Josh,
Sure.
do you see any time where it's not below 70?
Not below.
Oh, well, I'm sorry. We got 69. On
Yeah.
average, though.
You had to go back to 1950 to find that.
There we go. We got
Victor-
Victor's commented in.
Yeah.
We got tuned in. Victor's commented in. We got to go back to 1950 to get all the way to 1% below 70 at 69%. So it pays to stay in the market.
It does.
So the pattern has repeated itself since 1926. The bear markets on average are 11 months. Bull markets are 6.5 years. So, Josh, do you know who this is?
Nope. Not a clue.
All right. This is Rory McIlroy. He was one of the best golfers. He is one of the best golfers. And this is his coach. So this is what Josh, myself, and Victor are. We're your coaches. And the bottom picture actually is him and Rory and his coach. And this is in Florida. And he's been his coach since 9 years old. So I think he knows a little bit about how Rory's swing is. And even the best golfers in the world, even the best athletes in the world, they all have coaches. That's what we are.
He looks a bit like you, Max. He does actually.
Lucky
Hey,
guy.
Matt, what did you do this last weekend? Where were you at the Golden Bear?
Yeah, this last weekend I played in a charity event. I won the tournament, and because I have great coaches. I had great mental coaches here at Commonwealth Management
And
helping
what was
me
the name
through.
of the event?
It was the Jack Nicklaus Charity Golf Tournament. So won that tournament, brought the trophy to Commonwealth Management, and hopefully we'll have it for years to come.
We will have it for sure.
All right, so this is why all professional athletes and teams have coaches. Why? Because the average investor returns about 2%. And again, this isn't our study. This is a Dalbar study, independent third party. This is from 1999, the 20-year study. Average return of the investor with no manager is about 2% versus the market is about 6%. So it pays to have a money manager and someone that's been invested in the market.
Thesis: don't be a meme stock investor, folks.
Yeah. So we tie it all together. Those that fail to learn from history are doomed to repeat it. Those that learn from history can prosper. And what do we add, Josh?
We add historical context.
So, why does history repeat itself so often? Times change, but human nature doesn't.
That's
So, these are some of our on-demand workshops. Josh talked about cybersecurity. He did the cybersecurity, which was great. We also do estate planning, taxes and retirement, social security, and savvy IRA planning. If you have any questions regarding any of these things, feel free to call the office. One of us will be able to answer the question. All right. So thank you for joining us here
Thank
today.
you so much.
And always remember, we're here looking out for you.